Imagine you're walking down the street, and you pass by a $20 bill just sitting there. Would you pick it up? Of course you would. Now, what if I told you that every single year, many of us are leaving hundreds, even thousands, of dollars on the table, not on the street, but with the government? These aren't loopholes or risky maneuvers. These are legitimate tax deductions designed to help you keep more of your hard-earned money. Most people are completely unaware they qualify for them. This video will guide you through these often missed opportunities, demystifying the world of tax deductions so you can claim what's rightfully yours. First, let's get our terms straight. What exactly is a tax deduction? In plain English, a deduction is an amount of money that reduces your taxable income. Think of it like this. If you earned $50,000, but you have $5,000 in deductions, the government now taxes you as if you only earned $45,000. Less taxable income means a lower tax bill. It's that simple. This is different from a tax credit, which directly reduces the amount of tax you owe, dollar for dollar. Deductions reduce the income that gets taxed, while credits reduce the tax itself. Both are good, but today we are focused on those income-reducing deductions. Now for a crucial distinction: above-the-line versus below-the-line deductions. Don't worry, it's simpler than it sounds. Above-the-line deductions reduce your gross income to arrive at your adjusted gross income, or AGI. Your AGI is a very important number because many other tax benefits, including some credits and itemized deductions, are limited by it. These are often called adjustments to income, and anyone can claim them, regardless of whether they itemize or take the standard deduction. Below-the-line deductions, on the other hand, are the itemized deductions you claim after calculating your AGI. We'll dive into both, but understanding this difference is key to maximizing your savings. Before we get to specific deductions, you need to understand the fundamental choice you make every tax season: take the standard deduction or itemize. The standard deduction is a fixed dollar amount, set by the IRS, that reduces your taxable income. It's simple, no receipts needed. For many, especially after recent tax law changes, the standard deduction is generous enough that it makes more sense than itemizing. However, if your eligible below-the-line deductions add up to more than the standard deduction, you should itemize. You can't do both. The goal is always to choose the method that gives you the largest deduction and, therefore, the lowest tax bill. Here's a common misconception we need to debunk right away: I take the standard deduction, so I don't have any deductions to claim. This is simply not true. Remember those above-the-line deductions we just talked about? Many of them can be claimed even if you take the standard deduction. These deductions reduce your AGI before you even consider standard or itemized. This means they benefit everyone who qualifies, directly lowering your taxable income and, often, opening up eligibility for other tax breaks. Don't fall for the myth that only homeowners with piles of medical bills can benefit from tax deductions. Let's kick off our list of commonly missed deductions with one that's a triple threat: the Health Savings Account, or HSA. If you have a high deductible health plan, HDHP, you're likely eligible to contribute to an HSA. The money you contribute is tax deductible. That's benefit number one. It grows tax-free, benefit number two. And withdrawals for qualified medical expenses are tax-free, benefit number three. It's one of the most powerful tax-advantaged accounts out there, especially if you're healthy and can let the money grow over time. Don't overlook the immediate tax break from your contributions. Next up, your retirement savings could be saving you money today. Contributions to a traditional IRA, often tax-deductible. Whether your deduction is full, partial, or non-existent depends on your income level and if you or your spouse are covered by a retirement plan at work. But many people, especially those not covered by a workplace plan, or those below certain income thresholds, can deduct their full contributions. This is a powerful above-the-line deduction that can significantly lower your taxable income. Don't just set up the account. Make sure you're claiming the deduction for your contributions. If you're still paying off student loans, listen up. You can deduct the interest you paid on qualified student loans, up to $2,500 per year. This is another fantastic above-the-line deduction, meaning you can claim it even if you take the standard deduction. Many graduates, or parents helping their kids with loans, overlook this one. Your loan servicer should send you a Form 1098-A, which shows the amount of interest you paid during the year. Make sure you get that form and include this deduction. It can make a real difference, especially for those just starting out in their careers. Let's introduce you to Alex, a freelance graphic designer. Alex works from home, meets clients at coffee shops, and invests in new software and courses to stay competitive. When tax time comes, Alex often feels overwhelmed, thinking deductions are only for big businesses. But Alex, like many self-employed individuals and side hustlers, has a treasure trove of potential deductions just waiting to be claimed. If you have a side hustle, freelance work, or run your own small business, Alex's story is about to become your blueprint for significant tax savings. Get ready for some wait, really, moments. For Alex, and anyone self-employed, the golden rule is, if an expense is ordinary and necessary for your business, it's likely deductible. Ordinary means common and accepted in your industry. Necessary means helpful and appropriate for your trade or business. It doesn't have to be indispensable. This broad category covers a huge range of expenses from office supplies to marketing costs. The key is that the expense must be directly related to generating your business income. If you can draw a clear line between the expense and your earnings, you're probably in good shape. One of the biggest deductions for Alex is the home office deduction. But many people are scared to take it due to myths. Here's the deal. Your home office must be used exclusively and regularly as your principal place of business. Exclusively means it's only for business, not where you also watch TV or eat dinner. Regularly means on an ongoing basis. It doesn't have to be a separate room. It can be a dedicated space within a room. If you meet clients at home, that also qualifies. This allows you to deduct a portion of your rent or mortgage interest, utilities, and even depreciation. For those intimidated by calculating actual home office expenses, the IRS offers a simplified option. Instead of tracking every utility bill and measuring square footage, you can deduct a standard amount per square foot for your dedicated home office space. Currently, this is $5 per square foot, up to 300 square feet. So, a 100 square foot office could mean a $500 deduction without the headache of detailed record keeping. This is a fantastic way for Alex, and others like Alex, to claim a legitimate deduction without being an accounting wizard. Alex uses a car to meet clients, pick up supplies, and attend networking events. These business-related miles are definitely deductible. You have two ways to calculate this deduction: the standard mileage rate or actual expenses. The standard mileage rate is a set amount per mile, updated annually by the IRS, that covers gas, oil, maintenance, and depreciation. It's usually the simpler option. Alternatively, you can track all your actual costs, including gas, oil, repairs, insurance, and vehicle depreciation. This often yields a larger deduction if you drive an expensive vehicle or have high repair costs. Just remember, commute to your primary job doesn't count. To stay sharp, Alex takes online courses and attends industry conferences. Good news, these expenses are deductible. If the education maintains or improves skills needed for your current business or job, it's deductible. This includes tuition, fees, books, supplies, and even travel to and from the educational activity. The key here is that it can't be to qualify you for a new trade or business. So, if Alex takes a graphic design masterclass, it's deductible. If Alex takes classes to become a lawyer, not so much. This is a common missed opportunity for freelancers and employees alike. Many self-employed individuals like Alex pay for their own health insurance. Here's a huge deduction you might be missing. You can deduct the full amount of health, dental, and qualified long-term care insurance premiums that you pay for yourself, your spouse, and your dependents. This is another above-the-line deduction, meaning it reduces your AGI. The only catch is you can't be eligible to participate in an employer-sponsored health plan, either through your own employment or your spouse's. If you qualify, this deduction can be a significant savings, making self-employment more financially viable. Alex often meets clients for coffee or lunch. Good news, business meals are still 50% deductible. The rule is that the expense must be an ordinary and necessary business expense, not lavish, and you, or an employee, must be present. You must also keep good records, documenting the date, location, amount, and business purpose of the meal, including who you were with. While entertainment expenses are generally no longer deductible, the food and beverage portion of business meals remains a legitimate deduction. Don't forget to track these, as they add up throughout the year. For Alex, creative tools are essential. The cost of materials, supplies, and subscriptions to software used directly for business are all deductible. This includes design software, stock photo subscriptions, specialized pens, paper, and even a new laptop if it's primarily used for business. If you purchase equipment, like a new camera or computer, costing more than $2,500, you might need to depreciate it over several years, but smaller items are typically expensed immediately. Keep those receipts and track these smaller, but significant, business costs. They collectively chip away at your taxable income. Now you might be thinking, okay, that's great for Alex, but I'm a W-2 employee. Do I have any deductions I'm missing? And the answer is yes, absolutely. While many previous employee business expenses were eliminated by the Tax Cuts and Jobs Act of 2017, there are still significant above-the-line deductions that W-2 employees can claim. Plus, if you also have a side hustle, even a small one, you can often claim the self-employed deductions we just discussed. So don't tune out yet. Your tax savings journey continues, whether you're fully employed or dabbling in entrepreneurship. Are you a teacher, instructor, counselor, principal, or aide who works at a public or private school? If so, you might be eligible for the educator expense deduction. This above-the-line deduction allows eligible educators to deduct up to $300 or $600 if married filing jointly and both are educators, for unreimbursed ordinary and necessary expenses paid for books, supplies, other classroom materials, professional development courses, and even protective items for COVID-19. It's a small but important deduction that many dedicated educators overlook. Thank you for your service, and remember to claim this. This next one comes with an important date stipulation. If your divorce or separation agreement was executed on or before December 31st, 2018, and you pay alimony, you can deduct those payments. This is an above-the-line deduction, reducing your AGI. However, for agreements executed after 2018, alimony payments are no longer deductible for the pair nor taxable for the recipient. So, if you're in a pre-2019 agreement, make sure you're claiming this significant deduction. This is a big one for those who qualify, and it's easy to overlook if you're not specifically looking for it. For most people, moving expenses are no longer deductible. However, there's a specific exception: members of the armed forces who move due to a permanent change of station. This includes active-duty military members moving from one permanent duty station to another, from their home to their first duty station, or from their last duty station to their home. If you fall into this category, you can deduct the reasonable expenses of moving your household goods and personal effects and traveling to your new home. It's an important deduction for those serving our country, so don't miss it. Now, let's talk about those below-the-line deductions, the itemized ones. These are the deductions you claim if their total exceeds your standard deduction. Many people assume they won't have enough to itemize, but it's always worth checking, especially if you own a home, have significant medical expenses, or give generously to charity. We'll explore some of the most common itemized deductions that people often miss or underestimate, potentially unlocking hundreds or thousands of dollars in savings for you. Let's see if you're a hidden itemizer. Healthcare costs can be staggering, and a portion of them might be deductible. You can deduct unreimbursed medical and dental expenses that exceed 7.5% of your adjusted gross income, AGI. This means if your AGI is $50,000, you can deduct the amount of medical expenses above $3,750. This includes health insurance premiums, if not self-employed or already deducted, doctor visits, prescription medications, hospital stays, and even some transportation costs to medical care. Keep meticulous records of all medical expenses, even the small ones, because they can quickly add up and push you over that 7.5% threshold. This is a big one for many homeowners, but it also comes with an important limitation. You can deduct state and local income taxes or sales taxes, plus real estate taxes and personal property taxes. Collectively, these are known as SALT, or state and local taxes. The catch: there's a $10,000 cap per household on the total amount you can deduct for SALT. While this cap limits the benefit for those in high-tax states or with expensive homes, Many people still benefit from deducting property taxes and state income taxes up to this limit. Don't assume you're excluded. Check your numbers. For homeowners, the mortgage interest deduction is often the largest itemized deduction. You can deduct the interest paid on your mortgage up to a certain limit. For mortgages originated after December 15, 2017, you can deduct interest on up to $750,000 of mortgage debt. For older mortgages, the limit is higher at $1 million. Your mortgage lender will send you Form 1098, which clearly states how much interest you paid. This deduction, combined with property taxes, is often what pushes homeowners over the standard deduction threshold, making itemizing worthwhile. It's a huge benefit for home ownership. Giving back can also give you a tax break. You can deduct cash contributions to qualified charities, generally up to 60% of your AGI. You can also deduct the fair market value of non-cash contributions, like clothing, household goods, or appreciated stock. Remember to keep good records, a bank record or written communication from the charity for cash donations, and a detailed list with estimated values for non-cash items. For non-cash donations over $500, you'll need to file Form 8283. Your generosity can indeed be rewarded at tax time. Beyond direct cash contributions, don't forget the value of your non-cash donations. That old couch, those clothes you never wear, even books, if they're in good use condition or better, their fair market value is deductible. And here's a wait, really, moment. If you use your car for charitable purposes, like driving to volunteer or transporting donations, you can deduct 14 cents per mile for 2023. This small deduction often goes completely unnoticed, but if you're a dedicated volunteer, those miles can add up. Just remember to keep a mileage log specifically for your charitable activities. This might surprise you. You can deduct gambling losses, but only to the extent of your gambling winnings. This means if you won $1,000 from the lottery or casino, and you have $1,500 in documented gambling losses, you can only deduct $1,000. You can't use losses to create a net gambling loss that reduces other income. To claim this, you must itemize your deductions, and you need meticulous records of both your winnings and losses. While we don't encourage gambling, if you do, know you can offset some of those winnings for tax purposes. Here's another wait, really, moment for itemizers. When you deduct state and local taxes, you typically deduct state income taxes. However, if you live in a state with no income tax, or if your sales tax paid exceeds your income tax liability, you can choose to deduct state and local sales taxes instead. The IRS provides tables for average sales tax deductions by state and income level, or you can track every sales receipt if you had major purchases like a new car. Remember, this is part of the overall $10,000 SALT cap. It's a great option for those in sales tax heavy, income tax free states. A big reason many people don't claim legitimate deductions is fear of an audit. Let's debunk this myth. Claiming legitimate deductions does not significantly increase your chances of an audit. The IRS wants you to pay what you owe, no more, no less. If you have valid deductions and you keep good records to back them up, you have nothing to fear. It's fraudulent deductions or significant inconsistencies that flag an account, not simply taking advantage of what the tax code allows. Don't let unfounded fear cost you money. This cannot be stressed enough. Good record keeping is the absolute foundation for claiming any deduction. For every deduction, you need proof. This means receipts, invoices, bank statements, mileage logs, and detailed notes on the business purpose of expenses. Don't wait until tax season to gather everything. It's a recipe for stress and missed deductions. Adopt a system throughout the year. Whether it's a dedicated folder for paper receipts or a digital app, having an organized system makes tax time infinitely easier and ensures you have the documentation to back up every claim. In today's digital age, there's no excuse for messy record keeping. Many apps and software can simplify the process. From mileage trackers that automatically log your trips to receipt scanners that categorize expenses and upload them to cloud storage, these tools can save you hours and ensure accuracy. Consider options like QuickBooks Self-Employed for freelancers, or simple spreadsheet templates for W-2 employees with a few deductions. Investing a little time in setting up a digital tracking system can pay off immensely when tax season rolls around, ensuring you don't miss a single qualifying expense. Another common reason people miss deductions is thinking it's all too complicated. While the tax code can seem daunting, breaking it down into manageable parts, as we've done today, makes it much more approachable. You don't need to be a tax expert to understand the basics. The goal isn't to master every obscure rule, but to identify the common deductions relevant to your life. Start small, focus on the biggest opportunities, and build your knowledge year after year. The small effort you put in now can lead to significant savings later. While this video empowers you to find many deductions yourself, there are times when professional help is invaluable. If your tax situation becomes complex, say, you start a new business, buy investment properties, or have significant life changes, a qualified tax professional, like a CPA or enrolled agent, can be a game changer. They can identify advanced strategies and ensure you're compliant while maximizing your savings. Think of it as an investment. A good professional often pays for themselves by finding deductions and credits you might have completely overlooked. Don't hesitate to seek expertise when needed. Tax deductions aren't just something you deal with in April. They're something you can plan for all year long. By understanding potential deductions, you can make smarter financial decisions. Maybe you choose to fund your HSA more aggressively, or you decide to take that professional development course because you know it's deductible. Perhaps you're more diligent about tracking your business miles. Proactive tax planning turns deductions from an annual chore into a powerful tool for financial management, helping you optimize your spending and saving strategies throughout the year. Make it a habit to conduct an annual tax review, even if you do your taxes yourself. This means not just filling out the forms, but taking a moment to reflect on your financial year. What changed? Did you have a new job, start a side hustle, buy a house, or have significant medical expenses? Reviewing your situation can help you identify new deduction opportunities that might have arisen. This isn't just about avoiding mistakes, it's about actively seeking out every legitimate way to reduce your tax burden, ensuring you're not missing a single dollar you're entitled to. So, what's the ultimate takeaway from our journey today? It's simple. You are likely missing out on tax deductions. But with a little knowledge and some proactive effort, you don't have to be. Remember the distinction between above-the-line deductions available to everyone and itemized deductions that might require you to exceed the standard. Identify if you have a side hustle or are self-employed, as that opens up many more possibilities. And above all, keep those records. They are your proof and your ticket to lower taxes. Don't leave money on the table. Claim what's yours. You now have the tools and the confidence to start exploring your own tax situation with fresh eyes. Don't let fear or complexity deter you. Start with just one or two deductions that seem most relevant to you, gather your records, and see the difference it makes. Every dollar saved on taxes is a dollar you can invest, save, or spend on what matters most to you. So, take action. Go through your expenses, review your financial situation, and reclaim that hidden money. Your wallet will thank you. If you found this video helpful, please like, subscribe, and share it with someone who might also be missing out.